Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's get right into it. You ever wonder what really separates that tiny sliver of traders who actually make it from, well, pretty much everyone else who doesn't? According to Brent Donnelly's fantastic book, Alpha Trader, it's not some secret formula or a fancy algorithm. Nope. The real battle is won or lost right between your ears.
I mean, that one sentence, it just says it all, doesn't it? It's a brutal snapshot from one of the craziest days in market history, and it perfectly sets the stage for a story about the razor-thin line that separates a brilliant win from a complete disaster.
So we're going to kick things off with the true story of a hedge fund trader on May 6, 2010. Now, this was a day that started with a genius-level plan and then spiraled into total, absolute chaos. This isn't just a story about markets, you see. It's a story about what happens to the human brain under the most extreme pressure imaginable.
Okay, so check this out, because this is where it starts. Our trader was sharp. He spotted a clear mismatch in the market. See, the US dollar versus the Japanese yen, that's the candlesticks here. It almost always moves in sync with US bond yields, which is that dashed line. But on this day, they had totally split apart. He correctly figured that the dollar was way too high, and he set up a plan to short it. A smart, disciplined, well-researched trade.
And boom, his plan works. I mean, it works perfectly. The market does exactly what he thought it would. He shorts $100 million worth, and as the price drops, his profit and loss statement just explodes to a massive $2.8 million. To put that in perspective, that's more than he usually makes in a great month. Job done, right? And here we go. This is the moment everything changes. He's made his money, he's out of the market, he won the day. But then, that little voice creeps in. And it's not the voice of logic, it's not the voice of his research, it's the voice of pure, simple greed. And it's about to throw everything off the rails.
On a total whim, with literally zero analysis to back him up, he does the one thing you should never do. He completely reverses his winning strategy and goes long. The book says his hands moved as if possessed by some mischievous or evil force. He's not trading his plan anymore. He's just gambling on pure emotion.
And just like that, the bottom falls out of the market. The S&P 500 is in an absolute free fall. You've got the Squawk Box announcer literally screaming into his headset as prices just disappear. And the trader's P&L, which was a beautiful green $2.8 million just a few minutes ago, flips to the sickening, gut-wrenching six-figure red.
You gotta understand, in that moment, it wasn't just his account that was crashing. It felt like his entire world was crashing down around him. He'd made the perfect call. He executed it flawlessly. And then, he threw it all away on a stupid impulse. That feeling is just pure, self-inflicted despair.
And this chart, wow, it just shows you the absolute chaos he was swimming in. Look at that massive drop on May 6th. A normal day's price swing was about 87 pips. On this day, it was 604. That is nearly 7 times the normal volatility. The market wasn't just shaky, it was coming apart at the seams. This is the kind of environment where your own mind can become your absolute worst enemy.
But this is where the story turns. This is the redemption. Instead of panicking and making things worse, he does something so simple but so crucial. He recognizes he's emotionally flooded, that his brain can't make a good decision. So he physically tears off his headphones, stands up, and walks away from the screen to find a quiet moment. That one single act of self-control probably saved his entire career.
And that incredible story perfectly sets up the entire philosophy of this book. It's not just about what the market did, it's about the internal war that every single trader has to fight, every single day. The real enemy isn't some other trader or a fancy algorithm, it's the person staring back at you in the mirror.
And that's really the core of it, right? The market is going to do what the market is going to do. You have zero control over it. The only thing you can control is your reaction, your discipline, and your process. If you can master yourself, you at least have a fighting chance. If you can't, well, you're just gambling.
The book has this amazing name for this internal mess. It calls it our bias stew. And it's this, steaming hot bowl of all our human stuff. Our fears, our greed, our overconfidence, our past failures. It's always bubbling under the surface. The job of the alpha trader is to keep that stew from boiling over and making an already hard job completely impossible.
So, if the whole game is about managing yourself, then what does a winning mindset actually look like? This next part breaks down the specific psychological traits that really separate the pros from everybody else.
The book has this fascinating self-assessment grid, and it's really worth taking a second to think about this for yourself. I mean, be honest. Where do you fall on the spectrum from impulsive to rational? From snapping under stress to actually coping with it? Because knowing where you stand is the absolute first step to getting better.
Now here's what the book says the ideal profile looks like. Notice the super high scores in things like rationality, willpower, and coping with stress. Sound familiar? That's our trader from the story. After his huge mistake, he had to use every bit of these traits to claw his way back. He became the alpha trader right when it mattered most.
So when you boil it all down, these traits aren't about being a math genius. It's all about discipline and mindset. It's about being rational when you want to be emotional. It's about using logic, not just a gut feeling. And, maybe most importantly, it's about having a deep passion for the game of trading itself, even more than the money it can make you.
All right, so we know what the ideal looks like, but now let's get real for a minute and look at the cold, hard data. Just how tough is this game really, and why do so many people fail?
Here it is, the sobering reality. Studies suggest that only about 3 to 5% of independent traders ever achieve consistent, long-term success. Let that sink in. That means for every 100 people who try, up to 97 of them are going to fail. It is an incredibly difficult profession.
So you have to ask, why is that failure rate so high? Well, this chart gives us a huge clue. In one survey, a massive 70% of traders rated themselves as better than average, which, of course, is statistically impossible. This perfectly illustrates one of the biggest psychological traps there is, overconfidence.
The book calls overconfidence kryptonite, and that's the perfect word for it. It's what makes you think you're smarter than the market. It's what leads you to make impulsive trades with no logic behind them, just like our trader did when he flipped his position. It is one of the main reasons why so many incredibly smart people end up failing at this.
And that brings us to the final, most important takeaway. Becoming an alpha trader isn't like you reach some finish line and suddenly you're perfect. It's a constant, never-ending process. The markets are always changing, which means you have to be willing to change and adapt with them. It is a journey of continuous learning and, above all, continuous self-management.
So as we wrap this up, the real question the book leaves you with isn't about the market at all. It's about you. Knowing all this, what is your single greatest psychological strength as a decision maker? And what's your kryptonite? Because knowing the honest answer to that question, that's the first real step on the path to success.
You know, in the high-stakes world of trading, we're always taught to look for an enemy, right? We think it's the market, it's the algorithms, or it's the other traders. But what if the biggest battle isn't out there at all? What if it's actually happening right inside your own head? Today, we're going to pull back the curtain on that very idea. You've probably heard this classic piece of wisdom from Sun Tzu a million times. It's really the cornerstone of strategic thinking. But when you take this idea and apply it to the world of trading, well, it takes on a whole new, fascinating, and really powerful meaning. Because here's the thing, in this arena, you're not fighting the market. You're fighting your own emotions, your own biases, your own impulses. The enemy and yourself are one and the same. So succeeding isn't about outsmarting the world, it's about mastering you. So our first step, really, is to get to know this opponent, to look right in the mirror and see the trader who's staring back. Just think about it for a second. The most brilliant, foolproof strategy can be completely destroyed in an instant by a single irrational decision. The real hurdle isn't picking the right stock. It's managing that complex bundle of emotions and biases that make us human. And that right there is the fundamental question, isn't it? You just can't manage what you don't measure. So if we're going to win this internal battle, we need a tool for introspection. We need a clear, honest mirror. And that's exactly what we have here, a really powerful tool designed to give you a baseline, a kind of inventory of your own attributes as a trader. Now, what's really interesting here is the potential of this grid. Don't worry about filling it out right this second. Just kind of look at the categories, from risk-averse to risk-seeking, impulsive to rational. Try to be honest with yourself. Where do you think you land on an average day? Now, if you were looking closely, you might have suspected that this grid isn't just some random list of trades. Nope, there's a brilliant hidden logic to its structure, and understanding it is absolutely key. Let's break down how this is built. This assessment is intentionally designed to reveal different facets of your trading personality by sorting all these trades into 4 very distinct groups. Okay, so here's the secret sauce. The first group, traits A through D, this is all about balance. Being totally risk-averse is bad, but being a reckless risk seeker is just as bad. The goal is that productive middle ground. The second group, E through L, has all the traits you want to dial up to the max. We're talking rationality and decisiveness. Group 3, M to V, is the opposite. These are the liabilities you want to minimize, like being too emotional or disorganized. And finally, Group 4, W to Z, these are the influencers. They're not really good or bad, but they shape your style. Like maybe your introversion makes you a more patient, solitary researcher. Now that we get the framework, we can bring in a benchmark, a profile of what a theoretically ideal trader might look like. What are the traits that, when you put them all together, create the ultimate performer in the markets? Let's take a look. And this illustrates the goal perfectly. On the left, you've got our blank slate. On the right, the profile of the alpha trader. Now, it's super important to remember, this is an abstract ideal. This person doesn't actually exist. Think of it as a thought experiment, a North Star to help you see where you are versus where you could be. So, what are some of the highlights of this ideal profile? Well, rational thinking is number 1, the single most important trait, because it's your only defense against fear and greed. Confidence is vital for pulling the trigger, but it has to stop short of overconfidence, which is described as kryptonite because it makes you ignore risk. The motivation has to come from a real passion for the game of trading itself, not just the money, because that passion is what fuels discipline when things inevitably go south. And of course, logic almost always wins out over gut feel. But before we wrap up, there is one final, absolutely critical piece of this puzzle we need to talk about. It's a hidden bias that affects pretty much everyone. All right, here's the hard truth. We are all basically evolutionarily programmed to overrate ourselves. That score you just gave yourself in your head a minute ago, yeah, it's probably a little higher than reality. And in trading, that tiny little gap can be a very, very expensive mistake. And this isn't just the theory. We have the data. In a 2016 survey, a staggering 70% of traders rated themselves as better than average. 70%! And only 5% rated themselves as worse. Now, you don't have to be a math whiz to know that's statistically impossible. It's just not how averages work. This isn't just a fun fact, it's a huge warning sign. This bias is the root of so many trading errors, from holding losers way too long to taking on way too much risk. And the research also points out that, on average, men are particularly susceptible to this overconfidence, which often leads to the costly mistake of overtrading, basically just churning their own accounts into the ground. But here's the real takeaway from all this. This exercise isn't about getting a perfect score. The true value is in identifying your unique strengths so you can lean into them. And maybe even more importantly, exposing your weaknesses so you can build systems to protect yourself from them. Maybe that means keeping a stricter trading journal, using smaller position sizes, or even finding a mentor to keep you honest. That's where the real growth happens. Ultimately, all of this boils down to one simple truth. You cannot conquer an enemy you don't understand. And in the world of trading, that enemy is staring right back at you from the mirror. So, self-knowledge is the first and, without a doubt, the most important step toward victory. So, I'll leave you with this question to think about. Armed with this new mirror into your own trading psyche, what's your next move? How are you going to prepare for the real battle that lies ahead? So who hasn't dreamed of making a living as a trader? You know, the freedom, the challenge, the idea of these massive rewards. It's an incredibly tempting path, right? Especially because there are almost no real barriers to entry. But if it were that easy, wouldn't we all be doing it? Today, we are pulling back the curtain and looking at the hard, cold truth about the real odds of success. All right, let's just cut right to the chase with a simple question. Do you think trading is easy money? I mean, it's a super common idea, and it's fueled by all those stories of overnight millionaires. But the evidence we're about to dig into? Well, it paints a very, very different picture. Okay, let's break this down. On one hand, you've got the dream, right? Anybody can do it. You don't need a fancy degree, and the potential rewards seem almost infinite. But then there's the reality. And the reality is a brutal numbers game. A tiny, tiny fraction of people actually succeed. An even smaller group manages to keep that success going. And it turns out, just being smart and being driven, nope, that's not even close to being enough. So, to really understand why success is so rare, we have to get our heads around the basic nature of the game itself. And the truth is, the odds are kind of stacked against you from the moment you make your very first trade. You know, a lot of folks think trading is what's called a zero-sum game. The idea is simple. For every winner, there's a loser. If I make $1,000, it means someone else lost $1,000. And that makes people feel pretty optimistic, you know? They think, hey, all I have to do is be a little bit better than the next guy and I'll win. But that is a really dangerous way to think about it. Because here's the kicker. It's not a zero-sum game. The reality is, trading is a negative-sum game. And this is a huge critical difference. It means that when you add it all up, the total amount of money between all the traders is actually going down. But how's that possible? Well, this is how. This is where the money leaks out. Every single time you make a trade, you're hit with these costs. You've got your brokerage fees. You've got the bid-offer spread, which is that little slice the broker takes. You've got slippage, where your order gets filled at a price that's just a tiny bit worse than you expected. Then you add in the cost for your data feeds, your platforms. It's kind of like trying to fill a bucket that's got a whole bunch of tiny leaks in it. So what's the takeaway here? It's huge. Because of that constant financial drag, you're actually starting from behind on every single trade. You don't just have to be better than the other traders. You have to be so good that you can beat them and cover all those built-in costs just to get back to zero. You need a real serious edge just to break even. So we've established it's a negative-sum game. But what does that actually look like in terms of success rates? Well, let's dive into the cold, hard data. And fair warning, it's pretty brutal. Check this out. The research estimates that the success rate for independent day traders, we're talking about people trading their own money from their home office, is somewhere around a shocking 3 to 5%. Just let that sink in for a second. For every 100 people who give it a shot, about 97 of them are gonna fail. But then you see this. For traders who land a job at a big bank, the success rate skyrockets to around 50%. So what gives? How can there be such a massive, massive difference? And here's exactly why. It's not that bank traders are just magically smarter. It's that they have a huge structural advantage. First, they are intensely screened and vetted before they're even hired. Then they go through these massive training programs. They're surrounded by experienced mentors and, this is a big one, they often have a built-in edge just from their firm's business of making markets. It is a completely different universe. Now, I get it. These percentages might feel a little abstract, so let's bring it down to earth and back these numbers up with some real-world proof, both from personal experience and from academic studies. The author of our source material, Brent Donnelly, he shares this incredible story from his own time on a day trading floor back in the late 90s. He said he sat on a floor with about 50 desks, and he watched those desks turn over about 3 times in 3 years. So out of roughly 150 different people who tried their hand at trading, only 8, just 8 of them, actually made it. And if you do the quick math on that, 8 out of 150 comes out to a success rate of 5.3%. That is right in line with that 3 to 5% estimate we just talked about. And remember, this wasn't just some random group of people. They had all gone through a mandatory 2-week training course, and they still couldn't make it work. But look, this isn't just one guy's story from back in the day. A huge landmark academic study that looked at day traders in Taiwan during a massive trading boom found pretty much the exact same thing. I mean, just look at this. Over any given 6-month period, the study found that an incredible 80%, that's 8 out of every 10 day traders, lost money. This visual just makes that harsh reality so incredibly clear. And when you dig deeper into what they found, it gets even more eye-opening. They saw that the most active traders could often make gross profits, meaning they were good at pulling money from the market. But once you factored in all those transaction costs we talked about, they were actually losing money. In the end, the researchers concluded that only about 1%, just 1% of all traders, were able to generate consistent profits that you could actually say came from skill. So right about now, you might be thinking, okay, I get it. Day trading is super hard. But what about the real pros, the big shot fund managers with all the resources? Well, the story, it doesn't get much better. Just look at this. In a typical year, only about 28% of professional U.S. equity fund managers, people who do this for a living with massive teams and resources, actually manage to beat the market. That means almost 3/4 of them failed to do better than a simple, boring index fund. And if you zoom out and look at a 10-year period, the picture gets even worse. Over the last decade, just 11% of them succeeded. Let that sink in. For every 10 professional fund managers out there, 9 of them, 9, failed to consistently beat a simple market average over the long haul. The point is, even for the highest paid pros with every tool you can imagine, this is an incredibly difficult game. So why? Why is it so hard? It's because trying to beat the market means you are trying to solve one of the toughest puzzles on the entire planet. Modern markets are just incredibly efficient. You have millions of incredibly smart people and super powerful computers all hunting for the exact same tiny little advantages. You know, the researchers from that big Taiwan study summed it all up with this absolutely perfect analogy. Believing you can just waltz in and win at day trading is like walking into a casino, looking at the roulette table, seeing everyone losing money and saying, "Yeah, I know, but I'm different. I'm going to win." The odds are literally, mathematically fixed against you. Look, the point of all this isn't to crush anyone's dream. It's to give you a powerful, necessary dose of reality. The goal isn't just about being smart or working hard. The goal is to figure out how to survive in a negative-sum game where almost everyone fails. And that leaves us with the single most important question any aspiring trader has to answer. Knowing what the real odds are. What specifically is your edge?
You've probably heard a million times that success is all about talent or just plain hard work. But what does the data actually say? Today, we are going to dig into the science of high achievement. And trust me, the results are probably not what you're expecting.
So let's get right to it. What is the secret to success? I mean, is there some kind of magic formula? It's the billion-dollar question, right? And today, we're going to try to piece that formula together by looking at what the research actually tells us.
Okay, first things first. Before we can dive in, we really need to define what we're talking about. Success can be a pretty squishy concept. For some people, it's happiness, or health, or maybe just avoiding really bad outcomes. But when scientists study this stuff, they need to measure it in more concrete ways. So for our purposes here, we're going to focus on 3 of the big ones: income, educational achievement, and, your ranking in things like sports.
So where do we even begin? Well, let's start with the factor most people immediately think of: intelligence. Is being successful really just as simple as having a high IQ?
Well, right off the bat, we run into a problem. As this great quote from Daryl Huff points out, your standard IQ test, it doesn't really measure a lot of the things we intuitively connect with success, things like leadership, creativity, or just having good social judgment. So they're really an incomplete picture from the get-go. And this chart illustrates that point perfectly. What you're looking at is a plot of IQ versus income. And yeah, you can kind of see a general upward trend, but look at all that noise. It's all over the place. You've got people with really high IQs making very little, and people with lower IQs making great money. So clearly, there are other major factors at play here.
Now, check out what happens when we clean up that data a little bit. This is what's really interesting. Here, everyone is just grouped into low, middle, and high IQ bands. And suddenly, wow, the pattern becomes much, much clearer. The high IQ group doesn't just have a higher average income. Look at that right tail. See how much fatter it is? That means your chances of becoming a really high earner shoot way up.
So, can we actually put a number on this? Yep. Researchers estimate that for every single extra point of IQ, you can expect to earn somewhere between an extra $200 and $600 a year. It's a real, measurable advantage.
So here's the bottom line on intelligence. It absolutely matters. It seems to be a necessary part of the equation for success. But, and this is a big but, it is absolutely not sufficient on its own. It's just one piece of a much, much bigger puzzle.
So if IQ is just one piece of the puzzle, then what are the others? Well, this is where it gets really fascinating. The research points overwhelmingly to another massive factor: your personality. This might just be the hidden driver we've all been looking for.
Now, when we talk about personality tests, you're probably thinking of things like Myers-Briggs. But scientifically speaking, that's not really the gold standard. Researchers pretty much exclusively use what's called the Big Five model, or OCEAN, because it's based on actual data. It's repeatable, and it gives a much more stable and accurate picture of who a person is.
So what is this OCEAN thing? Well, it's just an acronym for the 5 big personality traits. You've got openness, that's your curiosity and how much you like new things. Conscientiousness, which is all about being organized, disciplined, and reliable. Extroversion, how outgoing and sociable you are. Agreeableness, your tendency to be cooperative and kind. And finally, neuroticism, which is basically a measure of emotional stability, or how likely you are to feel things like anxiety and stress.
Okay, so we've got our 5 traits. But when it comes to getting ahead in life and in your career, does one of them stand out from the pack? Is there a super trait for success?
And this right here is our first huge clue. You see, most of our personality traits are pretty stable throughout our lives, with one major exception. As this chart shows, our average level of conscientiousness goes up steadily as we get older. This is a big deal because it means it's not set in stone. It's a trait that can actually be developed.
And this, well, this is the money shot, literally. These charts are showing the direct impact of personality and IQ on what you earn. Just let your eyes scan across them. One of those panels just jumps right out at you, doesn't it? Look at that clear, strong, positive line going up and up. Yep, that's conscientiousness.
Let's just break that down nice and simple. Conscientiousness has a strong positive link to income. Extroversion, a small positive one. But get this, agreeableness, the trait for being friendly and compassionate, actually has a moderate negative correlation with income. It seems being too nice might literally not pay.
Okay, so we've got our 2 big factors so far, intelligence and the superpower of conscientiousness. But what about the stuff we can't control? There's one more piece to this puzzle we have to talk about, because the data shows it plays a massive role. The wild card? Luck.
I love this quote from E.B. White. Luck is not something you can mention in the presence of self-made men. It's so true, isn't it? Successful people almost never want to admit how big a role chance played in their journey. But the evidence is clear. It's a huge factor, especially when you're talking about extreme success.
And here is a perfect example of a powerful, subtle kind of luck. It's called the relative age effect. In elite youth sports, you see this massive overrepresentation of kids born in the first few months of the year. Why? It's simple. The cutoff date for the league means they're just a little bit older, a little bigger, and a little more developed than their teammates. So they get picked for the better teams, they get better coaching, and that tiny advantage just compounds over their entire career, all from the dumb luck of when they were born.
And if you want a more, shall we say, extreme example, get a load of this. In its very early days, FedEx was down to its last $5,000. It couldn't even make payroll. The founder, Fred Smith, took the company's last bit of cash, flew to Vegas, played blackjack, and won $27,000, just enough to cover the fuel bill and keep the company alive for a few more days. That is pure high-stakes luck.
So we've got our key ingredients: baseline intelligence, the superpower personality trait of conscientiousness, and the undeniable role of luck. So now, let's try to put all these pieces together into a practical formula.
So here it is, the formula, basically distilled from all the research. Success is a combination of conscientiousness, that's our superpower trait, plus IQ, which gives you a head start, plus your specific talent or skill. Then you've got to add a healthy dose of luck, and finally you have to subtract the impact of neuroticism, that tendency toward anxiety and self-doubt that can really sabotage everything else. That's the basic recipe.
Now, looking at that equation, what can you actually control? You can't change your luck, you can't easily boost your IQ, but you can actively work on your conscientiousness. Think of it as your personal superpower, and you can strengthen it. First, start with your mindset. Know that your abilities aren't fixed. Then, create systems to protect yourself when your willpower fails, things like automatic savings transfers. When a project feels huge, break it down into smaller, less scary chunks. Make lists, outsource your memory so your brain can focus on what's important. And the last 2 are just simple choices. Just decide to be punctual, and finally, adopt a mindset where you're always trying to make tiny, daily improvements.
So as we wrap this up, the key takeaway is that while some parts of success are totally out of your hands, the most powerful personality trait for getting ahead is not. It can be built. So looking at that list, what's one small change you can make today? Which area are you going to focus on first? So what's the real secret to trading success? I mean, is it about having some kind of genius-level IQ, a photographic memory, or is it something else entirely? Something a top trader has that maybe, just maybe, you have too. Well, today, we're going to cut through all the noise and look at the actual research to find that one ingredient that truly separates the best from the rest.
And who better to start with than the man himself, Warren Buffett? His advice is so simple but so powerful. He says, you don't need to be a rocket scientist. Rationality is essential. And that one word, rationality, that's the thread we're going to pull on today. Because it turns out, success in the market isn't about being the smartest person in the room. Nope, it's about being the most disciplined thinker. And this gets us right to a huge myth that a lot of people believe, the idea that you need 160 IQ to win at trading. But the research, it tells a totally different story. The variable that's actually crucial isn't just raw brain power, it's a high degree of rationality. And while those two might sound like they go hand in hand, they are fundamentally different skills.
All right, so what is this big secret then? We've dug into the research, and you know what? The answer is surprisingly simple. It really all boils down to two critical and kind of opposite traits.
And here they are, laid out plain and simple. The single best predictor of trading success? Rationality. And the single best predictor of failure? Overconfidence. I mean, just think about that for a second. One is all about clear, step-by-step thinking. The other is about believing deep down that you're just smarter than the market. One builds wealth, and the other one just torches it.
Okay, so we keep saying rationality is the key. But what does that even mean? To get it, we've got to take a quick look inside our own heads, because it turns out we're all running on a kind of two-system brain.
This is where something called the rationality quotient, or RQ, comes into play. It's not like your IQ, which is all about raw intelligence. No. RQ measures your ability to actually think things through, and maybe more importantly, to not just jump to a quick conclusion using those mental shortcuts that feel so right but are so often wrong. And here's the really crazy part, pointed out by researcher Keith Stanovich. Your standard IQ test, it completely misses this skill. You can literally be a certified genius and have a terrible RQ. In fact, get this, some studies show that super smart people can be even more vulnerable to certain biases because they're just so good at creating these really convincing stories to justify their own flawed gut feelings.
Probably the best way to wrap your head around this is with Daniel Kahneman's famous idea of two thinking systems. You've got system one. Think of it as your fast, gut reaction lizard brain. It's great for quick, everyday decisions. And then you have system two. That's the slow, deliberate, and frankly, kind of lazy adult in the room.
So let's break that down. System 1 is all about speed, but it's sloppy and full of biases. System 2 is where the real logic happens. It's the part of you that double-checks the work. And here's the real takeaway. Being a rational thinker doesn't mean you don't have that impulsive lizard brain. We all do. It just means you've trained the adults in the room to step in, slow things down, and ask, hey, wait a minute, is this really a good idea?
So you've got these two systems constantly battling it out in your brain. Want to see it happen in real time? Okay, let's do a quick question from something called the cognitive reflection test. It's designed to see which system answers first. You ready? Okay, here's the question. If it takes 5 machines 5 minutes to make 5 widgets, how long would it take 100 machines to make 100 widgets? Now really think about it. You can pause if you want. What's that very first answer that just jumps into your mind?
So, did the number 100 pop into your head? If it did, don't sweat it. That's what happens to most people, even very smart people. That's your system 1, your lizard brain, just doing what it does best. It sees a simple pattern, 5, 5, 5. So it just goes 100, 100, 100. It's fast, it's easy, and it's wrong.
The right answer is actually 5 minutes. Yeah, just 5 minutes. If you got that, seriously, nice job. It probably means you felt that little pull towards 100, but then your system 2, the adult in the room, stepped in and went, whoa, hold on a second. Let's actually think about the rate here.
And this is a perfect example of system 2 getting to work. It doesn't just jump at the easy pattern, it breaks it down. Look, if 5 machines make 5 widgets in 5 minutes, that means each machine takes 5 minutes to make its one widget, right? So if you've got 100 machines all working at the same time, they can each pop out their one widget in that same 5-minute window. It's simple logic, but it requires you to fight off that first, easy answer.
That little widget problem, it shows you the battle that's going on in our heads all the time. Now let's connect this back to trading and look at the actual research, the hard evidence that shows why this mental discipline is the real secret sauce for profitable traders.
Okay, so check out this first study. It's pretty incredible. Researchers put a bunch of traders in an experimental market. The results were crystal clear. The traders who scored highest on that rationality test, and yeah, the widget problem was part of it, made way more money. And their standard IQ, it was of marginal importance. It was their RQ, not their IQ, that predicted who won and who lost.
All right, let's look at another one. Here, researchers sorted traders based on 2 different skills. First was their analytical skill, logic, math, basically how rational they are. And second was their mentalizing skill, which is just a fancy way of saying how well they could read other people's intentions.
And wow, the results are just stark. You can see it right here.
The folks with low analytical skill, they barely made a dime. But look at the traders with high analytical skill. The profits just explode. That logical, rational thinking was the absolute bedrock of their success. Now, the superstars, the absolute best, they had both. But it's so clear that without that analytical foundation, being good at reading the room just didn't move the needle much.
And there's more. Another study found that, as a group, traders score way higher on these rationality tests than non-traders. They are consistently firing up that slow, deliberate System 2 thinking. And here's the part that I love, the real myth-buster. They do not rely on gut feeling any more than you or me. That whole image of the trader just running on instinct, it's a total Hollywood fantasy.
Now, this rationality shows up in a way you might not expect, by not doing anything. Yeah, you heard that right. Study after study shows that traders who trade less often actually perform better. And it's not just about saving on fees. Even if you take transaction costs out of the equation, the most hyperactive traders consistently underperform. A successful, rational trader isn't reacting to every flicker on the screen. They're using their System 2 to patiently wait for the real opportunities.
Okay, so we've looked at the brain, we've done the quiz, we've seen the research. So what's the bottom line here? What's the big takeaway? Well, we can actually distill all of this down into a pretty simple formula. And here's what it looks like. Trading success is your rational thinking plus your IQ plus your self-control. But look very closely at that last part. You have to subtract overconfidence. That is huge. It's not just about what you add to the equation, it's about what you take away. Because overconfidence is the one thing that can burn all your other advantages to the ground.
And that brings us to this final, elegant equation for what we could call the alpha trader. They're rational, intelligent, skilled, and conscientious. But that last piece is the real key. It's not just confidence, it's calibrated confidence. It's not about being cocky or arrogant. It's about having a brutally honest and accurate assessment of your own abilities, free from that destructive pull of ego.
So I'll leave you with this question to think about. Look at that alpha trader formula. Be honest with yourself. Which one of those traits is your natural superpower? And maybe more importantly, which one represents your biggest opportunity to learn, adapt, and grow? Something to think about. Thanks for tuning in.
Today, we are opening up the playbook of the world's most elite traders. We're going to figure out how they make incredible decisions under pressure, and more importantly, how we can all use their secrets to level up our own game.
So, what is it? What's the secret formula? It's the billion-dollar question, isn't it? If you could just bottle the essence of an alpha trader, what would actually be in there? Is it some crazy high IQ? Is it nerves of steel? Or is it something else completely?
Well, here's the answer. And yeah, if you're looking at this and feeling a little overwhelmed, you're not alone. That's a huge list. But don't worry, this isn't about being born with all these traits. Think of it as a journey, and we're going to break this whole thing down into a clear, manageable path.
Right, so here's the most important thing to get. There's no single magic bullet. Becoming an alpha trader is all about mastering a combination of skills that anyone can build. We're going to walk through the key areas, starting with the mental frameworks that really set the elite apart. First up, let's talk about how you think. See, top-tier performance isn't just about knowing a bunch of facts and figures. It's about how you process information. It's about the mental models you use to make decisions. This, right here, is where the pros really separate themselves from the rest of the pack. And the cornerstone of that whole toolkit is being an independent thinker. But let's be super clear on what that means. This is not about just disagreeing with the crowd for the sake of it. Being a contrarian just to be contrarian. No. A true independent thinker develops their own way of looking at the world and comes to their own logical conclusions. To see how hard this is, just look at the famous Asch conformity experiment. People were shown these cards and asked a really simple question. Which line on the right, A, B, or C, is the same length as the one on the left? The answer is obviously C, right? It's a no-brainer. But here's the crazy part. When the person being tested was surrounded by actors who all confidently said the wrong answer, a shocking 37% of people went along with the group and gave the wrong answer too. That's how powerful the social pressure to conform is. It can literally make us deny what we see with our own eyes. Resisting that pull, that's a superpower. So, resisting that external pressure is one half of the battle. The other half is internal. It's what's going on inside your own head. And this is where another critical tool comes in, the growth mindset.
Top performers don't think their talents are just fixed things they were born with. They believe their abilities can be developed, through hard work and persistence. They see a challenge and think opportunity to grow, not threat to avoid.
And all this leads to this really powerful idea: having strong opinions weakly held. It means you have the confidence to come up with an idea, to form a conclusion, but you also have the humility to actively try and prove yourself wrong. You're constantly looking for evidence that challenges your beliefs. You engage in what Paul Sappho calls creative doubt.
Okay, so having all these great mental models is fantastic, but it's totally useless if you can't actually act on them. So for our next section, we're moving from thinking to doing. We're talking about execution.
And here is the absolute core philosophy. You have to obsess over what you can control. In trading, or really any complex field, there's just a ton of luck and randomness involved in any single outcome. The amateur gets hung up on the result. The pro focuses relentlessly on their decision-making process because they know that a good process leads to good results over time.
This little matrix right here, this is one of the most important tools for checking your work. Look, good process, good outcome, great, celebrate, but don't get cocky. Good process, bad outcome, that's just bad luck. Learn from it, stick to the process. But the real danger zone, the trap, is that bottom left box, a bad process that somehow leads to a good outcome. That's just getting lucky, and it teaches you all the wrong lessons.
And this quote just says it all, doesn't it? This is the theme song for what you might call Hindsight Harry, the person who's always talking about what they should have done or what could have happened. They live in the past, obsessed with outcomes. The pro is always looking forward, focused on how to make their process better for the next decision.
So what does a good process actually look like on a daily basis? Well, it's about being organized and intentional. It means you have a plan every day. You collect data on how you're doing. You write down your goals. You keep a journal. This is the stuff that turns what feels like chaotic gambling into a professional operation.
All right, you've got the sharp mind. You've got a great playbook, but can you actually execute it when the heat is on? Now we enter the arena. This part is all about forging the emotional and psychological armor you need to not just survive, but to win.
And this chart explains the fundamental challenge better than anything. It shows that, for our brains, the psychological pain of a loss feels about twice as powerful as the pleasure from an equal-sized gain. We are literally hardwired to hate losing, which makes taking smart, calculated risks feel incredibly scary.
Just look at these numbers for a second. Here's a trader who made 320 grand in 1 year. A fantastic result, right? But to get there, they had to sit through 100 separate losing days. 100 times they had to feel that stinging pain of loss we just saw on the chart. I mean, that is a brutal emotional roller coaster. And that right there is why grit isn't just a nice to have. It's an absolute requirement. Grit is the thing that lets you stick to your plan, to your process, even when you fall down, screw up, and feel like you're going nowhere. It's getting knocked down 100 times and getting back up for round 101.
So the goal is to find that perfect balance. You need the courage to act, to take risks based on your convictions. But that courage has to be balanced with discipline so you don't become reckless. It's like being a race car driver. You have to go fast enough to win, but not so fast that you fly off the track and crash.
And that brings us to our final section. And honestly, this might be the most important idea of all. Being an alpha performer isn't some finish line you cross. It's a commitment. It's a constant, never-ending process of getting a little bit better every single day. The quest to level up, it never ends.
So I want to leave you with a practical tool you can use today. This comes from the CIA, of all places. It's called Analysis of Competing Hypotheses. And the key is step 4. Instead of trying to prove your favorite idea is right, this process forces you to actively try to disprove all your ideas. It is an amazing way to fight your own biases and just flat out think better.
Because when you boil it all down, everything we've talked about really comes back to self-awareness. You have to know yourself. You have to understand your own strengths, your weaknesses, your emotional triggers. It's only when you really understand your own internal operating system that you can manage your weak spots and truly play to your strengths.
And we'll end with this thought from Peter Thiel, which just wraps everything up perfectly. The most contrarian thing of all is not to oppose the crowd, but to think for yourself. True success doesn't come from just fighting what everyone else is doing. It comes from the much harder and much more rewarding work of learning how to truly, genuinely think for yourself.
Welcome to The Explainer. It's the big question on everyone's mind. Why do most traders actually lose money? Well, today we're going to dig into that. We're going to uncover the hidden forces, the real kryptonite that sabotages success. And we're pulling our insights straight from the book Alpha Trader. All right, let's start with a really crucial and honestly often overlooked reality of the markets. People love to say trading is a zero-sum game, right? For me to win, you have to lose. But that's not quite right. It's actually a negative-sum game. What does that mean? It means the house, the brokers, the exchanges, the data providers, they're always taking a slice. So the total pie is actually shrinking, which makes it that much harder for anyone trading to walk away winner. So yeah, before we even get into the psychology of it all or the fancy strategies, we've got to understand the arena we're playing in. The game is literally rigged against you from the get-go. There's this constant headwind you're fighting against. I mean, just think about it for a second. Every single time you place a trade, you're fighting against all these little drags on your performance. You've got the obvious stuff, right? Your tech, your data feeds, your research. But then there are the transaction costs, the commissions, the spread, and that pesky thing called slippage that just chips away at your profits. And that's not even the whole story. You, as an individual, are up against giant institutions with way more information and blazing fast algorithms. The deck is definitely stacked against you. And this is so important today. You see all these commission-free brokers, right? Well, you have to remember the old saying, if the product is free, you are the product. What's really happening? Your trade order is getting sold to high-frequency trading firms who then make a tiny profit off of it. So the cost is still there. It's just hidden from view. Okay, so we've talked about all the external stuff, the costs, the competition, but here's the kicker. The market itself isn't your biggest enemy, not even close. The real battle, the one that really matters, well, that one is fought inside your own head. And when you look at the data, when you read what the pros say, it is absolutely crystal clear. Forget about finding the perfect magic strategy. The number one reason traders fail is just bad discipline. That's it. You could have the best system in the world, but if you can't actually follow your own rules, it's completely worthless. And this gets to the heart of what makes trading so incredibly difficult. It's this great paradox. On one hand, you have to be a risk taker, right? You got to be willing to jump in and attack when you see a great opportunity. But on the other hand, you need to be insanely disciplined. You have to patiently follow your rules and just wait and wait and wait for that perfect setup. Most of us lean one way or the other, but to succeed, you have to be both at the same time. It's a real balancing act. I love this quote because it's just so true. The market is like that siren's call from the Odyssey, constantly trying to lure you onto the rocks. And that siren song, the author calls it the demon voice in your head. You know the one. It's that little voice whispering, hey, just move your stop a little further, or go on, chase that trade, you can make it back, or the classic, let's break the rules, just this once. All right, so we've established discipline is king, but what are you being disciplined about? Your strategy, right? Your edge. Well, let's talk about that, because the whole idea of having an edge is a lot trickier than you might think. It's like chasing a ghost in the market. Just look at this chart. It shows the performance of trend-following strategies over time. That line, the Sharpe ratio, is basically a measure of how good your returns are for the risk you're taking, and you can see it just steadily drops over the decades. A strategy that was printing money back in the 80s is barely even working by the 2010s, and the reason is simple. Markets adapt. As soon as an edge becomes well-known, a flood of people jump on it, and poof, the edge disappears. So the key takeaway here is that no edge lasts forever. They're not permanent. They're constantly being discovered, used up, and then they vanish. This means your job as a trader isn't just to find a strategy that works. Your real job is to be smart enough to know when that strategy has stopped working. Okay, let's do a quick little experiment. This is a fun one because it really shows you how our brains are hardwired to see patterns, even when there's nothing there. So look at these two charts. Pretend they're a mystery asset. What do you see? Is there an uptrend, a downtrend? Can you spot any support or resistance levels? If you had to place a bet right now, would you buy or would you sell? Just take a second and form an opinion in your head. You ready for the reveal? They are 100% random. I just made them in Excel. So if you saw a beautiful uptrend or a perfect head and shoulders pattern, I'm sorry to say, it was all in your head. That was just your brain trying its best to find order in complete chaos. It's an incredible example of how easily our own minds can fool us in the market. And that leads us perfectly into the biggest kryptonite of them all. The one force that completely destroys discipline and makes us see things that just aren't there. And that force, of course, is emotion. Now, usually when we talk about emotions in trading, we think about the bad stuff, right? Frustration after a losing streak, which leads to tilt or revenge trading. But here's the crazy part. Euphoria, feeling like a genius after a bunch of wins, can be just as dangerous. They call it winner's tilt. You start feeling invincible, you get sloppy, you take bigger risks, and you know how that story usually ends. The author tells this amazing personal story about it. He actually realized that the moment he felt the best, the most excited, the most euphoric, even yelling with joy, was almost a perfect signal that his profits were about to completely crash. And he even has a name for it, the cheer hedge. And look at this chart from his own account. That absolute peak in his P&L, that's the exact moment he stood up and yelled, "FX is back," across the entire trading floor. His moment of maximum excitement was the literal exact top of his position. It's an incredible picture of how feeling too good can be the ultimate sell signal. So, let's recap. We've got a negative-sum game, our own discipline is our worst enemy, any edge we find will disappear, and our emotions, both good and bad, are trying to sabotage us. Man, knowing all of that, how on earth does anyone actually survive in this business long term? Well, it really all boils down to one thing: survival. Your first job, before you even dream about making millions, is to not go broke. It's all about defense. And bad risk management is the quickest ticket to failure. It'll get you in one of three ways. 1, you have the risk of ruin, betting so big that one bad trade just wipes you out. 2, you have the slow bleed, where you cut your winners short and let your losers run, just draining your account over time. And 3, you fail to adjust your position size when the market gets wild or quiet. And that brings us to the final piece of kryptonite, being rigid, not being able to adapt. So many traders who have a great run eventually fail because they just stick to that one thing that worked for them. But the market doesn't care. It's a living, breathing thing that is constantly changing. And if you don't change with it, you're going to get left behind. It's as simple as that. So now that we've seen all this kryptonite, all these hidden traps, it should be pretty clear that the goal isn't some magic holy grail strategy for winning. The real game, the real challenge, is developing the self-awareness to stop yourself from losing. So the most important question isn't, how am I going to get rich? It's, what's my plan to survive my own worst instincts?
You know, one of the biggest aha moments you can have is realizing that being smart doesn't actually stop you from doing stupid things. It happens all the time. And once you really get that, the world and, your own decisions, they start to make a whole lot more sense. So today, we're going to dive into the cognitive biases that trip up even the sharpest minds out there, and what you can actually do about it.
So let me just ask you straight up, can you always trust your own mind? You probably think, yeah, of course. But the truth is, your brain is kind of hardwired with these little bugs and shortcuts that can lead you completely astray, and you often don't even realize it's happening.
Okay, take a look at this. This is called the Hermann grid illusion. Look at where the black squares intersect. You probably see some faint gray dots, right? Well, they aren't actually there. Your brain is literally adding them in. And here's the crazy part. Even now that you know it's a trick, you can't not see them. That is exactly how cognitive biases work. Just knowing about them isn't enough to make you immune.
All right, let's get into what might be the single most devastating bias of them all: overconfidence. You know, there's this razor-thin line between the confidence you need to succeed and the overconfidence that basically guarantees you'll fail. One is absolutely critical, the other is deadly.
Think about the 2020 Super Bowl. The San Francisco 49ers, they go up by a commanding 20-10 late in the game. And what do? Their entire defense runs into the end zone for this big group celebration photo, acting like the game is already over. I think you can guess what happened next. Their opponent scored 21 unanswered points and won the whole thing. That celebration, that one single moment of pure, unadulterated overconfidence, it led directly to their downfall. And the parallel in trading and investing is just so clear, isn't it? The second you start pumping your fist over a trade you haven't even closed yet, you are in the danger zone. And look, overconfidence isn't just one thing. It actually comes in three main flavors. First, you've got overestimation.
That's just thinking you're better at something than you really are. Then there's overplacement, which is the classic better-than-average effect, where something like 93% of US drivers think they're better than average, which is, mathematically impossible. And finally, there's miscalibration, being way, way too certain about your own predictions.
And hey, this isn't just some abstract theory. In one study, researchers measured how well calibrated traders were, basically how good they were at knowing what they didn't know. The results? They were absolutely stunning. As you can see on the left, the group with the best calibration, the ones with some intellectual humility, they made huge profits. And over on the right, the group with the worst calibration, the most overconfident, they lost the most money. It's a direct link. It's that simple.
Now, overconfidence often leads us right into our next mental bug, this addiction to action. We have this deep-seated, powerful urge to always be doing something, to be making moves. But in so many high-stakes games, the most powerful move is to just do nothing at all.
And here's why that urge is so ridiculously powerful. Neuroscientists have actually found that the anticipation of making money, it activates the exact same reward circuits in your brain as addictive drugs, like cocaine. That little dopamine hit you get from clicking buy or sell can be just as compelling and just as dangerous.
So it's really worth asking yourself, are your actions being driven by a clear strategy or by a craving for stimulation? This checklist here is actually adapted from the official diagnostic criteria for gambling disorder. If you look at this and recognize yourself in 4 or more of these points, that's a pretty strong sign that your desire for action might be overriding your rational judgment.
And get this, there was this incredible study where researchers looked at the cars that hedge fund managers drive. What they found was that the managers who owned high-performance sports cars, a signal of sensation-seeking, they took on way more risk, traded more often, and ultimately delivered lower returns. And the minivan drivers? Yeah, the minivan drivers consistently outperform them. It just goes to show that a patient, less action-addicted temperament can be a massive advantage.
So what's the antidote to this whole action addiction? It's realizing that having no position, being flat, gives you the ultimate power. You're unconstrained, you're open-minded, and you're ready to pounce on a real opportunity when it comes along. See, inaction isn't laziness, it's a strategic position of strength. It's like being a wolf waiting in the long grass.
But these biases, they don't just affect our actions. They actually distort how we see the world in the first place. They cause us to filter reality to match what we already believe, trapping us in this little echo chamber of our own making.
And first up is the big one, confirmation bias. We all do this. As soon as we have an idea in our head, we instinctively go looking for evidence that proves we're right, while we just conveniently ignore or dismiss anything that suggests we might be wrong. We're not actually seeking truth, we're seeking validation. And a close cousin to confirmation bias is extrapolation bias. This is our tendency to see a recent trend and just assume it's going to go on forever. When something's going up, we forecast it'll go up more. When it's going down, we expect it to keep on dropping. It's not really forecasting, it's just following.
You can see this perfectly in action right here with professional analyst forecast for currency and oil crisis. The solid black line is what really happened. The dotted gray line, that's the average forecast. Just notice how the forecast is always lagging behind reality. The analysts only predict a turn after the market has already turned. They're not predicting the future, they're just extrapolating the recent past.
Okay, so we've seen how our own brains can fool us, but the good news is we are not helpless. This final part is a practical toolkit, a set of real techniques you can start using right away to fight back against these biases and make more rational decisions. So first, to fight that overconfidence, run a pre-mortem. It's so simple, but it's incredibly powerful. Before you commit to a big decision, just imagine it's a year from now, and that decision has failed spectacularly. Now tell the story of why it failed. This forces you to see the plan's weaknesses and confront all the risks you might have otherwise just ignored. Next up, to fight confirmation bias, you can use a technique called stealing thunder. It's actually inspired by that final rap battle in the movie 8 Mile. The goal is to go out and find and understand the arguments against your idea so well that you can argue them better than anyone else. If you can't poke serious holes in your own idea, your thinking is probably biased.
And finally, to fight that addiction to action, you literally need to create friction. Put some speed bumps between your impulse and that buy button. Use a checklist. Set a hard limit on the number of trades you can make each week. Step away from the screen. These little barriers can make a massive difference in preventing impulsive emotional decisions.
Because ultimately, success isn't just about being intelligent. It's about being rational. It's about knowing your brain has bugs, and then having the humility and the tools to work around them. Because the one thing you can absolutely be sure of is that smart people do stupid things all the time. So the real question is, what are you going to do to make sure you're not one of them?
You know that feeling when you're staring at a stock chart and you just get the sense that you're missing something important? Well, you probably are. There's this whole hidden layer to the markets that really separates the pros from the amateurs. And today, we're going to peel back that layer and look at the actual machinery underneath. We are talking about market microstructure. Okay, so let's just dive right in. For most people, a stock chart is just, well, it's noise, right? Kind of like a random walk. But hiding underneath all that noise is a secret world, a super complex machine with its own rules, its own rhythms, and its own key players. We've all seen this a million times. It's just a line that goes up and down. But only watching this line is kind of like trying to understand how a car works by only looking at the spinning wheels. Sure, it tells you the result, but it tells you absolutely nothing about the cause. And that is the key question. What is the machinery that's actually driving these price changes? Understanding this, that's your first real step toward developing a genuine edge. See, the most successful traders, they don't dabble. They don't have a shallow understanding of 14 different things. Nope. They go narrow and deep. They become true experts in just one or two markets by obsessively studying their hidden mechanics. So this obsessive study of the hidden mechanics, this whole narrow and deep expertise, well, it actually has a formal name. It's called market microstructure. To put it simply, it's the study of how markets actually work. This isn't about having a crystal ball to predict where the price will go next. It's about understanding how it gets there, the process, the participants, and all the plumbing of the system. And the good news is we can break this all down into 4 core components. First, the participants. Who's actually in the game? Second, liquidity. What are the real and often hidden costs? Third, intraday patterns. Does the market have a kind of daily heartbeat? And finally, volatility. How much does the price typically jump around? If you can get a handle on these 4 pillars, you're golden, and we're going to tackle each one. Let's kick things off with the first 2 components, which are probably the most fundamental: the players in the game and the price you really end up paying. These factors are shaping every single transaction, whether you can see them or not. Every market is like its own diverse ecosystem. You've got retail traders on their phones, massive pension funds moving huge sums, super aggressive hedge funds, and sometimes even central banks stepping in. Each of them has totally different goals, right? And knowing who the dominant players are in your market gives you so much context. A market driven by long-term funds is going to behave completely differently from one driven by short-term speculators. Now, let's talk about liquidity, because this is where we find a silent killer of trading performance: transaction costs. And I'm not talking about commissions. I'm talking about the bid-ask spread, that tiny little difference between the buying price and the selling price that acts like a slow, constant leak in your financial tire. So let me introduce you to Tiffany. She's a really active day trader, making about 15 round-trip trades every day. She's trading a popular stock where the spread is about 66 cents. Sounds tiny, doesn't it? I mean, 66 cents, who cares? Well, let's do the math and see how you feel then. That tiny, almost unnoticeable spread, when you multiply it by her trading activity, is costing her nearly $1,500 every single day. Now let's zoom out to a week. That invisible little leak has siphoned away over $7,000 from her account. And annually, we're talking over $350,000. Poof, gone. Not from a bad trade, but just from the cost of getting in and out of the market. That's the absolutely brutal compounding power of transaction costs. And this chart right here, this shows you exactly what that looks like in the real world. That top gray line, that's the fantasy. That's the trader's gross profit, what they think they're making. But the black line below it, that's their reality after costs. Just look at the chart on the left. What looks like a winning strategy is actually a losing one. On the right, a great strategy becomes just mediocre. That gap between the lines is the transaction cost, and it's often the entire difference between success and failure. Okay, so transaction costs are a slow bleed, but there's another danger hiding within liquidity. And this one is more like a sudden heart attack. It's called gap risk. It's an extreme, explosive kind of volatility where a price doesn't just move smoothly. It instantly teleports from one level to another, leaving you absolutely no chance to get out in between. Let's look at a classic, almost infamous example, the Facebook IPO. Focus on that price line. See how it keeps hitting a floor at exactly $38, but it just can't break below it? Now look down at those huge vertical bars at the bottom. That's the order book depth. And those massive spikes represent a giant artificial buy wall put up by the IPO underwriters just to support the price. So you're watching this, right? You see a buyer with what looks like infinite pockets holding the price at $38. It seems like the safest trade in the world. I mean, just buy at the floor? What could possibly go wrong? Well, the very next day, that infinite buyer was just gone. And the price didn't gently drift down. Oh no, it gapped open, instantly teleporting from $38 down to around $34. Anybody who bought at that safe floor was immediately trapped in a losing position with zero chance to escape. That is gap risk. All right, let's shift gears to our next component because this is where things get really interesting. It turns out that markets aren't just chaotic and random. They have a predictable daily rhythm, kind of like a heartbeat. Just take the S&P 500 futures, a major benchmark for the US stock market. Look at the volume. Those gray bars at the bottom, you see a huge surge right at the market open, a really distinct lull in the middle of the day, and then another huge surge right into the close. This happens almost every single day. It's not random. It's a structural pattern. And hey, it's not just stocks. Here's the euro. The volume peaks right when the London and New York trading sessions overlap, which makes sense. That's the busiest time for global finance. Again, it's a predictable rhythm driven by the mechanics of the market itself. And check out crude oil. That insane spike you see isn't some surprise news announcement. It happens every single day at 2:30 p.m. Eastern. Why? Because that's the NYMX settlement time, when a huge number of contracts get priced. The crucial point here is that these patterns are not random noise. They are structural, baked-in features of the market. So why does any of this matter? Because understanding these hidden mechanics isn't just an academic exercise. It's how you develop a real, tangible, and maybe even unfair advantage. This is your new toolkit. Knowing the daily rhythm means you can choose to trade during high-volume periods to get better prices, or you can just avoid the midday lulls altogether. Understanding liquidity and gap risk means you can set smarter stop losses or avoid holding risky positions overnight. Recognizing the players gives you context for the price action. It's about using the market's own machinery to your advantage. You know, there's this classic joke about two economists walking down the street. One sees a $10 bill on the ground, and the other says it can't possibly be real because in a perfectly efficient market, someone would have already picked it up. That is a losing mentality. The markets are very efficient, yes, but they're not perfectly efficient. There are opportunities hiding in plain sight for those who actually know how to look. So, the next time you look at a chart, don't just see a wiggling line. Ask yourself, who's trading right now? What are the hidden costs? What is this market's natural rhythm? Because the answer to those questions, that's where you'll find the patterns that are hiding in plain sight. You ever look at the stock market and just think to yourself, this makes absolutely no sense? Well, today we are peeling back the curtain. We're going to uncover the hidden language that really drives the financial world. So let's start with, the most basic question of all, right? What really moves it? We're all taught to ask, what are the earnings? What's the economic data telling us? But what if the answer is something far more human and a lot less rational than we think? I mean, think about it. If it were just about the numbers and the data, markets would be predictable. But they're not, are they? They're chaotic, they're emotional, and a lot of the time they seem to defy all logic. The quantitative story on its own, it just doesn't add up. So, here's the crucial point, the real secret. The market isn't driven by objective reality. No, it's driven by the story that the majority of people agree to believe in at any given moment. It's basically a collective active faith, a shared narrative. So let's start by looking beyond those numbers. In this first part, we're going to explore why markets can feel so chaotic and why understanding the story is the absolute key to making sense of it all. The legendary investor Charlie Munger, he really knew that to understand the world, you have to understand its stories. And the market, it's no different. It is a vast, interconnected web of stories, and our job is to learn how to read them. Now, what's really fascinating about this whole thing is how markets can seem to only focus on one big story at a time. So between 2010 and 2012, both the Eurozone and the US had massive economic problems. Traders had a great name for it: two garbage trucks colliding. But here's the thing, the market didn't trade them both as bad. Instead, it would fixate on the Eurozone crisis, so everyone's selling the euro. Then, suddenly it would pivot to the US story of quantitative easing, the central bank printing money, and then everyone would start selling the dollar. It's this perfect illustration of how the market's attention is singular. It just latches onto one dominant narrative. So, all of this brings us to the core concept. What exactly is a market narrative? Let's spend a minute just defining what we mean when we talk about reading the market story. It's actually pretty simple. A market narrative is just the story the market tells itself to make sense of what's going on. It's the plot line, right? It's the explanation that justifies why a stock, a currency, or an entire index is going up or down. And this is a really critical distinction to make. Fundamental analysis is what you think the story should be. It's your personal take on the data. But narrative analysis, that's all about figuring out what story everyone else is telling. It's about understanding the consensus, not just proving your own theory right. Okay, now here's where it gets really, really powerful. These stories, they aren't random. Nope, they follow a predictable pattern. So let's break down the life cycle of a typical market narrative, from its quiet beginning to its dramatic, messy end. This chart right here is our roadmap. So the dotted line, that's the story's momentum. The buzz, the hype. And the solid line is the price. As you can see, the story often leads the price, both on the way up and on the way down. The narrative actually turns before the price does. And at the heart of the most explosive part of this entire cycle is one of the most powerful human emotions in finance: FOMO, the fear of missing out. It's what drives people to just pile in at the very top, right as the story is about to completely fall apart. Let's walk through these 7 stages. It all kicks off at stage 1, under the radar. A new story forms, but only a few contrarians are even paying attention. Then in stage 2, momentum builds. The story starts going viral among the pros, and you see the price begin to move. Then we hit stage 3, the primary trend. Now the hype is real, and every single dip gets bought up. But then, stage 4, we see the first cracks. Some bad news hits, something that threatens the story. And this leads to the most dangerous part, stage 5, the final hype wave, where FOMO just goes into overdrive and pulls everybody in at the top. Stage 6 is the peak and the turn. This is that critical moment where the narrative dies, even if the price hasn't totally collapsed yet. And finally, stage 7, the end. The market just gets bored and moves on to the next shiny new story. So how does a story finally die? Well, a lot of the time, the price itself is what kills it. This old saying captures it perfectly. When prices get high enough, they naturally choke off demand and encourage new supply, which eventually causes the price to fall and the whole narrative to just break. Okay, so we get the theory, but how do you actually get good at this, right? How do you become an expert at reading the market story? Let's get practical and talk about 4 key habits you can build. First, you have to read everything all the time, like a fiend. Second, you got to build a network of people to bounce ideas off of. Third, in today's world, you absolutely must understand the central banks. They are a huge force in the global story. And fourth, you have to identify and follow the true subject matter experts in whatever market you're looking at. Now, for that first habit, reading, it's about quality, not just how much you read. You have to become a master filter. You want to focus on forward-looking analysis and unique insights. And you need to avoid the noise. Things like those generic market recaps that just tell you it already happened. Or, those crazy long-term forecasts that are just pure guesswork. No market exists in a vacuum. The real magic happens when you start to see how the story in one market affects the story in a totally different one. This is all about connecting the dots across the entire financial system. And that's because these markets, they don't all move in perfect sync. One can often act as a leading indicator for another. And when you spot these relationships, honestly, it can feel like you've been given the answers to the test before it even starts. And this is a fantastic illustration of that very idea. On the left, you can see that back in August 2020, stocks were going up, but so was the volatility index, the VIX, which people call the market's fear gauge. Now that's weird. Normally, when stocks go up, fear goes down. This divergence was a huge red flag. And sure enough, on the right, you see what happened next, a pretty sharp market correction in September. The VIX was telling a different story, and guess what? It was the right one. These relationships are everywhere you look. The Australian dollar, for instance, is tied to the price of copper because of Australia's exports. Gold is super sensitive to U.S. real interest rates. The Canadian dollar often moves in lockstep with the price of crude oil. Learning these connections is a core part of reading the market's bigger global narrative. Ultimately, it all comes back to this famous analogy from the economist John Maynard Keynes. Success in the market isn't about your own personal judgment of what has value. It's a game of guessing what story everyone else is going to believe. You're not picking your favorite, you're trying to pick the crowd's favorite. So now you have the tools to decode the market's secret language. The question is, when you look at the world right now, what's the dominant story being told? And maybe more importantly, what stage of the cycle is it in? All right, today we are diving deep into technical analysis. Looking at charts, all those lines and squiggles, trying to predict what the market's going to do next. But what if that whole idea is just wrong? What if the pros are using those exact same charts for something completely different? Something way more powerful than a crystal ball? Let's get into it. I mean, this is the million-dollar question, right? Can you actually look at a chart and somehow see the future? Well, according to Brent Donnelly, a veteran trader and the author of our source material, Alpha Trader, the answer is a hard no. So if it's not about prediction, what in the world are the pros doing with these things? That's exactly what we're about to find out. So let's start with the big, shiny idea that gets everyone hooked in the first place, this whole concept of the chart as a crystal ball. And you can see the appeal, right? I mean, who wouldn't want to find some kind of secret code hidden in the market's wiggles? A pattern that basically tells you, hey, the price is going here next. It's a super powerful and alluring idea, and it's what pulls so many people into the world of trading. But does it really work? So does this whole idea of predicting the future with charts actually hold up when you really look at it? Let's put that belief to the test and see what happens when you compare these strategies against, well, just pure random chance. And the author, who is a professional trader himself, really doesn't pull any punches. He just comes right out and says it. Charts are not a good forecasting tool. And look, he argues this isn't just his opinion, right? This is a conclusion that's backed up by a ton of academic research. For example, one really interesting study did something kind of brilliant. It took 4 of the most popular technical strategies out there, things like RSI and MACD, the ones you see everywhere, and it put them head-to-head against a trading strategy that was 100% random, basically a coin flip. And the results? They were pretty stunning. The study found that over the long haul, those standard popular trading strategies did no better than the totally random one. Actually, the random strategy was way less volatile, way less risky. So the big takeaway here, that predictive edge everyone talks about, it just wasn't there. So this is the key question, isn't it? If charts can't predict the future, are they totally useless? Have the pros been pulling a fast one on us this whole time? Well, no, not at all. It just means we've been asking the completely wrong question. So let's totally shift our perspective. Let's build out what this actually looks like for a professional. See, the pros don't use charts for forecasting. They use them as a set of tactical tools for execution, and this is the really crucial part, for managing their risk. Okay, first tool in the kit. It's a brilliantly simple idea called the news pivot. Think about it like this. The price of anything is just the equilibrium of all the information everybody knows. But when big news hits, bam, that equilibrium gets shattered, and the market has to scramble to find a new fair price. That last price, right before the news broke, that's the news pivot, and it becomes a hugely important psychological line in the sand. Here is a perfect example. The Fed announced it was going to start buying corporate debt, and this bond ETF, HYG, just shot straight up. But look what happened next. The price before the news pivot, was right around $78. And you can see the market came all the way back down to test that exact level, not once, but multiple times. And it held. Now that's not a prediction. That is a powerful tactical signal telling you where the market's new floor might be. All right, next up in the toolkit, good old support and resistance. And really, these are just a logical reflection of supply and demand. If a price keeps bouncing off a certain level, it's just telling you that there's a big cluster of buyers, that's support, or sellers, that's resistance, hanging out right there. It's like the market's memory, right there on the chart. Now, take a look at this chart of the British pound. You can see how price found really strong support around that 13,000 level. It held and held. But once that support finally broke, what happened? That exact same level flipped and became major resistance. See, for a pro, this isn't a crystal ball, it's a map. It's showing you exactly where the new battleground between the bulls and the bears is. So, knowing where these key levels are is one thing, but what about timing? Let's look at a few simple patterns that pros use, not to predict where the market's going, but to time their entries and exits with a bit more precision. Another great tool is just recognizing symmetry. It kind of makes sense, right? Markets often move in these symmetrical ways. So on the left, you've got the US dollar versus the Canadian dollar. It goes on this massive run up, and then it gives back almost the entire move. And on the right, the Chinese yuan traces out this almost perfectly symmetrical M-shaped pattern. For a trader, seeing these patterns complete gives you a really clear tactical signal that maybe, just maybe, the trend is getting exhausted. Okay, now here's where it gets really tactical. Let's take a pattern like a rising wedge. A pro's process is not to just see the wedge and immediately sell. No way. Step 1 is you have to have a fundamental reason to think the market should go down. The chart pattern, the wedge, that's just the trigger. You wait for the price to break the pattern, then you enter, and you do it with a clearly defined risk level. This chart of crude oil shows it perfectly. You can see the price is grinding higher, but it's doing it in this narrowing, weakening pattern. So for a trader who is already bearish on oil for, say, fundamental reasons, that sharp break below the wedge, that was the go signal. That was the tactical entry point to act on their idea. And here are two more simple but really powerful signals. First, you've got the doji. It kind of looks like a plus sign, and it basically shows pure indecision. The market is just balanced on a knife's edge. Then you have the hammer. This shows that sellers tried to push the price way down, but they failed, and the buyers rushed back in to take control. Both of these are little clues that a trend might be running out of gas. Okay, so moving beyond just the charts themselves, pros are also looking at sentiment and positioning. You can think of this like trying to figure out how much fuel is available for a potential fire. And this is just such a great analogy. For a really big market move like a panic, you need 3 things. You need fuel. That's a whole lot of people crowded into the same trade. You need heat. That's a catalyst, some kind of news event. And you need oxygen. That's feedback loops like margin calls that force even more selling. Just having a crowded trade isn't enough to start a fire. You need all 3. And listen, here is probably the single most important thing you need to remember about sentiment. Most of the time, like 80 or 90% of the time, it just follows the price. People are bullish because prices are going up. So trying to fight that is just picking a fight with a trend. The only time sentiment becomes a useful signal to go the other way is when it hits a crazy historical extreme. So let's bring all this together. What is the one golden rule for using technical analysis like a seasoned pro? I absolutely love this quote. It just sums everything up perfectly. Your actual trade idea, the why, that has to come from your fundamental view. That's the cake. Technicals, that's just the frosting. It's the timing, the tactics, the risk management. It makes the whole thing work. But you cannot make a cake out of just frosting. And that's really the question to take away from all this. When you look at your own approach to the markets, ask yourself, have you built a solid engine, a real core reason for why you're in a trade? Or are you just chasing the frosting? The answer to that question might just make all the difference.
All right, let's get right into it. Today, we're talking about what our source material calls the single most important skill in trading. And spoiler alert, it's probably not what you think. It's not about nailing the perfect entry or having a crystal ball. It's something way more fundamental. And if you can master it, it can completely change your game. So, let's dive in.
And look, there's no beating around the bush here. This is the core idea. You could have the greatest trade ideas in the world, the fastest execution, all of it. But if you don't have a rock-solid risk framework, you are basically just gambling. This isn't just a friendly suggestion, it's the golden rule.
So what's the whole point of great risk management? Well, it's to make your P&L curve look like a call option. Think about that for a second. Your downside is capped, you have limited losses in your bad years, but your upside, it's practically unlimited. You get these massive, explosive gains in the good years. This totally flips the script, turning risk management from just defense into a seriously powerful offensive weapon. So how do you even get there? How do you achieve that kind of performance? Well, it all starts with data.
specifically your own data, because you can't even begin to manage your risk until you can actually measure your performance. You've probably heard this before, right? You can't manage what you don't measure, and it is so true in trading. Keeping a journal is great for getting that qualitative feedback, how you are feeling, but analyzing your actual profit and loss data, that gives you the cold, hard, quantitative truth. It's the only way to really know what's working and what's not, so you can do more of what works and, just as importantly, less of what doesn't. Okay, so what stats are we talking about? This table breaks down the big ones. You've got your win percentage, but here's the thing, that's actually really hard to influence directly. The real magic, the metric you can actually control, is your win-loss ratio. This number, how big your average winning day is compared to your average losing day, that is the truest reflection of your actual trading skill.
Okay, so how does tracking all this data actually build up to that call option style performance we talked about? Let's get into the nitty-gritty, the practical framework that puts it all together.
And boom, here it is. This chart is the perfect picture of what we're aiming for. Just look at it. Over 20 years, the losing years, they're just tiny little blips below the zero line, barely noticeable. But the winning years, whoa, they have these massive, massive spikes. Now that's not by accident. It's the result of a very specific strategy. You start every year risking small, and you only start taking bigger risks after you've built up a profit cushion.
Now, to make this work, you have to understand this concept of free capital. And no, that's not your entire account balance. Think of it as the amount of money you can truly afford to lose in a year and still be in the game to trade again. For a pro trader, this is their formal annual stop loss. For a retail trader, it's the part of your account that you've mentally set aside as your risk capital for the year.
And this slide shows you exactly how it works in practice. See how as your P&L grows throughout the year, your risk allowance, your maximum monthly loss, also gets bigger and bigger? When you're down or flat, you're risking a tiny amount. But once you're up big, maybe over 6 million, like in this example, you're allowed to risk 5 times as much each month. You literally earn the right to take bigger shots. That's how you create those giant upside spikes.
All right, so having a great system is one thing. But what happens if you just completely ignore the most fundamental rule of risk? Well, let me tell you a story. Let's talk about a guy named Jerry. Jerry was, by all accounts, a natural, a true prodigy, a 21-year-old kid who could just read the tape and feel where the market was going next. He had zero formal training, but his instincts were so good that a veteran trader actually closed his own account just to put all his money behind Jerry.
But, and there's always a but, isn't there? Jerry had a fatal attraction to danger. He absolutely loved shorting these tiny, thinly traded microcap stocks. The kind of trades where your potential profit is capped, but your potential loss is literally infinite. He was warned over and over again, Jerry, one day, one of these is not going to come back down.
And you can probably guess what happened. One day, a stock he shorted just kept going up and up and up, wiping out his entire account and then some. But because he was so talented, he actually got a second chance with a fresh stake. And 4 months later, boom, he did the exact same thing again. He flew straight into the wall twice. So the lesson from Jerry's story is crystal clear, and it's the most important one. Rule number 1 is survival. Don't blow up, period. You should never, ever enter a trade if you aren't 100% confident you can exit it. Don't trade things you can't get out of. It is really that simple.
So Jerry's story is all about avoiding the risk of total ruin. But what about that other kind of risk? The one that comes from just plain old random luck. This amazing quote from way back in 1774 just nails the essence of what traders call variance.
Take a look at these charts. Every single one of those gray lines represents one simulated year for a trader who has a winning strategy, a positive edge. But look at the insane spread of the outcomes. It's the exact same trader with the exact same strategy, but one year they might make $50,000, and the next they make $150,000. The only difference between those outcomes? Pure luck. That's the power of variance.
And that's why one of the most vital skills you can develop is learning to tell the difference between a loss from variance and a loss from a bad process. On the left side, you've got acceptable losses. You were just wrong, or you got unlucky with some news. It happens. That's just part of the game. But on the right, you have unacceptable losses. You broke your own rules. Your discipline fell apart. You were right about the market, but somehow still lost money. That's a huge red flag that something in your process is broken.
So, with all this in mind, how do you actually put it into practice on an individual trade? How do you decide how big to bet?
The source lays out a really clear 5-step process. First, you have an idea. Second, you figure out your conviction level. Third, based on that conviction and your overall risk framework, you decide on the exact dollar amount you're willing to lose. Fourth, you find a logical stop loss based on the market, not some random percentage. And then, and only then, as the very last step, do you calculate your position size. The big takeaway here is that your position size is the output of your risk process, not the input.
Now, all this talk about rules and systems might sound kind of conservative, right? But then you see this quote from the investing legend Stan Druckenmiller, and it just flips the whole thing on its head. He says the only way to get superior returns is by being a pig. The whole point of this disciplined framework isn't to make you timid. It's to tell you exactly when the odds are in your favor and when you have a cushion of profits. It gives you the confidence and the green light to be a pig, to bet really big when it truly counts.
So at the end of the day, a great risk system provides the structure. It identifies the opportunities for you to have those huge, outsized gains. It tells you when to be patient, and it tells you when to be aggressive. But the system can't press the button for you. So the final question is really a personal one. When that rare, high-conviction moment arrives, will you have the courage to actually seize it?
You ever wonder how the pros really come up with their trading ideas? Sometimes it can feel like they're playing a completely different game, right? Well, today we're going to pull back the curtain on that whole process. We're going to dive right into the professional framework for how they find and develop their ideas from scratch.
I mean, it's pretty much the biggest question every single trader asks at some point, right? And listen, it's not about getting lucky or finding some secret magic indicator. It turns out there's an actual system, a kind of life cycle that pros use to turn raw information into a trade they feel really confident about. And you know what? It all starts with just knowing where to look.
And here you have it. This is the system we're talking about. Look, this grid, it's more than just a simple process. Think of it as a roadmap. It literally takes you all the way from that first little spark of an idea right through to the final analysis of how it all went. This right here is how you start to think like a pro.
Okay, so the full process has 7 steps, but for this explainer, we're really going to focus on the engine of the whole thing. Step 1, which is all about idea generation. We're going to break down the 4 key ways the pros do this: surfing the narrative, capitalizing on events, finding market imbalances, and then wrapping up with recognizing patterns.
Right, so before we jump into generating ideas, just take one last look at this whole life cycle. You can see it's just this logical flow, from idea all the way to analysis. A structured process that pros use day in and day out.
All right, let's kick things off with the big one. Seriously, according to our source material, this is the #1 source of trade ideas for the pros. It's called surfing the narrative. And now, this isn't just about scanning headlines. It's something much, much deeper. It's about understanding the story the market is telling itself.
So what exactly is the narrative? Well, think of it like this. It's the main story that the market is completely obsessed with at any given moment. Is the big story all about inflation, or maybe it's about some new tech revolution? Or is everyone whispering about a recession? Becoming a true expert in this story, knowing all the characters, the plot twists, what's important and what's not, that is probably the single most important step you can take to becoming an expert trader.
Okay, let's make this real. Imagine you're trading gold, and boom, this headline hits your screen. Now, for most people, this is just another piece of data. Is it good? Is it bad? Who knows, right? You're kind of frozen. But for an expert who's been surfing the narrative,
well, they can process it in a split second. They already know if the market even cares about Indian demand right now, or if the story is all about, say, central bank policy instead. They know if this number was expected. And this deep contextual knowledge lets them react way faster and way smarter than everyone else. They can turn that headline into a trade or just confidently say, nope, that's noise. That's the edge.
All right, let's move on to the second major source of ideas: capitalizing on events. Now, we're talking about those big moments you can circle on your calendar, you know? Things like company earnings reports, Federal Reserve meetings, major economic data releases. These are huge moments of opportunity, if you know how to play them.
now here's where it gets interesting, because the core philosophy here might feel a little backwards. The most powerful position you can have going into a huge news event, it's often having no position at all. Yeah, being flat, because it gives you something absolutely priceless: total and complete objectivity.
And here's exactly why that's so powerful. First up, you've got something called gap risk. That's when some crazy news comes out and the price literally jumps or gaps open, flying right past your stop loss. You have no control. Second, and this one is huge, is confirmation bias. We're all guilty of this. It's that tendency to see what we want to see.
If you're already in a long position, you're going to be looking for any scrap of good news and probably ignoring all the flashing red lights. And finally, if you're wrong, it is so hard to admit it, ditch that losing idea and flip your position on a dime.
So what's the big takeaway here? It's that the edge is not in trying to be a fortune teller. It's not about guessing what's going to happen. The real sustainable edge comes from being so prepared that you can react to whatever actually happens faster and smarter than anyone else. It's all about reaction, not prediction.
Okay, time for our third source of ideas. This one is all about putting on your detective hat. It's about looking for clues in markets that are related to each other and spotting those moments when things just don't quite add up. You're looking for what the pros call a deviation from fair value.
And this example is a perfect way to understand it. Let's walk through this little story. So, step 1, you've got a thesis. Some bad economic data comes out of China. Simple idea, short mining stocks. Makes sense, right? But wait, before you hit the button, you do your detective work. You notice that even though the mining stocks aren't moving much, copper, which is totally related, is actually up. This should make you stop and ask, wait a minute, if the market was really worried about China, wouldn't copper be down? The market's reaction is telling you your story is wrong, and just like that, you stand down. You just avoided a bad trade by listening to the clues.
Okay, let's get to our final source of ideas, and that's pattern recognition. And what's really cool about this one is that it's not just a practical tool, it also teaches us something really important about the mindset you need to be successful. This is kind of where the practical side of trading meets the philosophical.
Now, when we say patterns, I want to be clear, we're not just talking about drawing some lines on a chart. We're talking about broader, recurring tendencies in the market. You know, things like seasonality, how some assets tend to perform better or worse during certain months. The old saying is that history doesn't repeat itself, but it often rhymes. And those rhymes are what we're looking for.
And check this out. Here is a shockingly consistent historical pattern. If you look at major market bubbles that have burst, we're talking the NASDAQ in 2000, Bitcoin in 2017, even going all the way back to the 1929 crash, the asset typically falls about 85% from its peak before it finally finds a bottom. It's a pretty sobering number, but it's an incredibly useful historical pattern to keep in your back pocket.
So this is a fantastic visual example of a specific type of pattern called an analog. What you're looking at here, that dotted line, is the Euro's rally back in 2017. And the solid line, that's the rally in 2020. I mean, look at that. The path from 2017 provided an almost perfect roadmap for what happened later. So pros will look for times in history that had a similar backdrop, and they'll overlay the charts like this to see if history is, rhyming. It's not a crystal ball for sure, but man, is it a powerful tool for context. So, after going through all these practical ways to find trade ideas, our source material brings it all home with this one essential piece of wisdom. It's a famous quote, and it's really the mindset that ties this entire framework together.
And here's the bottom line. Professional trading is not a treasure hunt for that one perfect, flawless, once-in-a-lifetime trade. You know what that search gets you? Paralysis. You end up doing nothing. Instead, it's about the disciplined, consistent execution of lots of good enough trades. Trades that tick your boxes, that fit your framework, and that give you a solid edge. It's all about process, not perfection.
And so that's the question I really want to leave you with. As you work on your own trading, ask yourself this. Are you searching for the perfect trade or the good enough one? Because your answer to that question could truly make all the difference in the world.
When you look at the world of trading, what's the one thing that separates the pros who last for decades from the folks who flame out in just a couple years? It's not some secret indicator, it's adaptation. The thing is, in the markets, the only thing you can count on is change. So if you're just clinging to one strategy, you're setting yourself up to fail. The real key to making it long-term is being flexible.
And look, this isn't just some trading guru advice. It's a fundamental law of survival. H.G. Wells, he wasn't looking at stock charts, obviously, but he could have been. The market is just a giant ecosystem. And just like in nature, if you don't evolve, you go extinct. Simple as that.
So this gets us to the big question, right? The problem that every single one of us faces as a trader. You find something that works, an edge that's just printing money. And then, poof, it stops working. So why? Why does this happen? It's so frustrating. And for some people, it can literally end their career. Well, here's the answer. The market, it's like this incredibly efficient discovery machine. As soon as a profitable strategy is found, word gets out. And then what happens? More and more people crowd into that same trade, and all that competition just squeezes the profits until there's nothing left. It just gets competed away. I mean, think about high-frequency trading back in the 2010s. At first, those firms were making absolutely insane profits, but by the end of the decade, the arms race got so intense that most of their strategies barely even covered their costs. The edge was gone.
So that brings us to our first section here, the fading edge. We're going to dive into how the market's constant evolution means any single advantage you find is, well, temporary.
Just look at this timeline. It shows how the ground is just constantly shifting under our feet. And we're not talking about minor tweaks here. These are like earthquakes for traders. I mean, back in 2001, U.S. stocks switching from fractions to decimals. That completely changed the game. Then a few years later, you have algorithmic trading taking over, making it way tougher to trade manually. Then we get flash crashes, a whole new kind of risk. And more recently, free retail stock trading has created these wild bull runs in totally new market dynamics. Every single one of these events meant you had to adapt, or you were just going to get left behind.
And that really leads us to the core idea of this whole explainer. The market itself is a giant adaptive system, so to survive in it, you have to become one too.
You know, this quote just captures the rhythm of the markets perfectly, doesn't it? Hours of boredom punctuated by minutes of extreme terror. Most of the time, yeah, things are pretty quiet. But your entire career, it can be made or broken by how you handle those few terrifying moments of pure chaos when a crisis hits.
And this chart of the VIX, the market's fear gauge, this shows you exactly what those moments of terror look like on a graph. Just look at those massive, rare spikes. Each one of them lines up with a major financial crisis. You've got the Asian financial crisis, 9/11, the 2008 meltdown, the COVID crash. So for our purposes today, let's just define a crisis as any time the VIX shoots above 40.
Now, here's the crucial part: how rare these events actually are. Since 1990, the VIX has closed above that crisis level of 40 on only 2.2% of trading days. Think about that. So these are the moments that have the greatest potential for profit, but also the greatest chance of totally blowing up.
Okay, so in those super rare moments of chaos, how do you not just survive, but actually thrive? Well, that's exactly what we're going to get into in this next section. The very first thing you have to get your head around is that in a fast, chaotic market, pretty much everything you thought you knew gets tossed right out the window. All those reliable patterns, the indicators that were working perfectly just last week, they become totally useless. In fact, they can be downright dangerous.
Okay, this right here is one of the best visual examples of this I have ever seen. On the left, you've got 5 months of this beautiful, predictable, range-bound trading in the euro. Super easy, right? You buy near the bottom, you sell near the top. It was a great strategy. Now, look at the right. When the COVID crisis hit in early 2020, that entire predictable structure was just obliterated, wiped out by this massive one-way spike. The old rules just completely broke.
So, if the old rules are broken, what replaces them? Well, it's a whole new mindset. First up, position size is everything. It becomes your #1 tool for balancing survival with opportunity. Second, you've got to use your imagination, because in a crisis, prices can go to places you literally thought were impossible. Third, forget about overbought or oversold. Those concepts just don't apply in a panic. And last but not least, you have to have courage. You can't just hide under your desk. These moments of extreme fear are exactly where trading careers are made.
Okay, so that's how you handle the sheer terror of a crisis. But adaptation, it's not just for those crazy moments. It's really a daily practice. So let's talk about the practical tools every trader should have in their toolkit.
Here's a really simple but profound difference between amateurs and pros. A lot of traders, they tend to use the same position size no matter what. But the alpha traders, the real pros, they systematically adjust their size based on volatility. It's simple. When vol is high, they trade smaller. When vol is low, they can trade larger.
And this chart makes that idea super concrete. Let's imagine a hypothetical trader Frank. His rule is simple. He risks the same dollar amount on every single trade. Let's say it's $20,000. But now, look at how his position size changes. When the VIX is super calm, under 12, he's trading 23 S&P contracts. But in a full-blown crisis, with the VIX over 40, he's only trading 3 contracts. See? It's the exact same dollar risk, but the position size is perfectly adapted to the environment. This is an absolute game changer.
Okay, another key tool is learning how to identify the market's personality, what we call a market regime. Is the market trending hard in one direction? Because that's when you want to use breakout strategies, buy high and sell even higher. Or
Is it just chopping back and forth in a range? Because then you want to do the opposite. Buy low, sell high. Using the right strategy for the right regime is absolutely crucial.
And the good news is, you don't need a PhD in statistics to figure this out. This little matrix here gives you a super simple tool using just 2 moving averages. So, for example, if the price is above both moving averages, and the faster one is above the slower one, boom, you're in a clear uptrend. Almost any other combination suggests you're probably in a range. It's a simple but really powerful way to make sure your strategy matches what the market is actually doing.
All right, finally, we're at what I think is the most difficult part of adaptation. Because this isn't about tools or charts, this is all about your mindset.
You've probably heard this famous advice from the novelist William Faulkner. In writing, you must kill all your darlings. What he meant was, it doesn't matter how much you love a certain sentence or a character. If it doesn't serve the story, you have to be ruthless and cut it. And wow, does that apply perfectly to trading? Think about it. That strategy that made you a boatload of money 2 years ago, that's your darling. But if the market has changed, and it always does, and that strategy stops working, you absolutely cannot stay emotionally attached to it. You have to be willing to kill it and go find what works now. And I absolutely love this quote from Lewis Carroll's Through the Looking Glass. It's called the Red Queen Effect. The Queen says, "It takes all the running you can do to keep in the same place." In this hyper-competitive market, that's so true. You have to work constantly, learn constantly, adapt constantly just to stay in the game. And if you actually want to get ahead, as the Queen says, you have to run at least twice as fast as that.
So I'm going to leave you with a question to really think about. What's the one method, the one belief, the one darling strategy of your own that you know has stopped working, but you're still holding on to it? Be honest with yourself. Because just identifying it, that's the first real step toward true long-term adaptation.
All right, let's get right into it. Today, we're diving into this huge idea from Brent Donnelly's book, Alpha Trader. What does it really take to master the mindset of a pro? You know, the core idea sounds simple enough. In any high-stakes game, whether you're a trader, an athlete, an entrepreneur, you just can't succeed without the right attitude. But is it really all just about thinking positive all the time? Well, that one little word, maybe. It might just be the key to the whole thing. It's the ultimate pro response to the crazy ups and downs, the wins and the losses. And to really get why it's so powerful, we have to start with a story. So let's jump into this. Picture a farmer way back in ancient China. His life is about to get hit by a bunch of events that, to anyone else would look like really good luck or really bad luck. But this farmer, he knows something we don't.
So it starts when the farmer gets a horse. All his neighbors come over, they're celebrating, "You're so lucky!" And he just looks at them and says, "Maybe." A few days later, the horse runs away. They all rush back. "Oh, what a terrible disaster!" Again, he just says, "Maybe." But then the horse comes back and it brings 6 wild horses with it. "This is incredible! You're rich!" they cheer. And his response, you guessed it, maybe. The story keeps going. His son tries to tame one of the horses, falls, and breaks his leg. "Such horrible luck," they say. Maybe. The very next day, the army storms through the village, forcing all the able-bodied young men to join the war. But his son, because of his broken leg, is spared. "You are the luckiest man alive." And for one last time, the farmer just says, "Maybe."
The whole point of that story is that we just never know how the movie is going to end, right? Getting super excited about a win or completely crushed by a loss, well, it's a recipe for burning out. This whole parable of maybe is really the foundation for a mindset that can actually last in the long run. Okay, so we've got this maybe philosophy as our base, but how do we actually build on that? Well, the next step is all about defining your mission, and that has to start with some brutally honest self-evaluation. Seriously, take a second and actually think about this. The research is super clear on this. Professionals who take the time to self-evaluate, who set real goals and then make a plan to get there, they just consistently outperform everyone who doesn't. It might sound a little cheesy, but it's a massive competitive advantage. And to prove this isn't just talk, the author actually shares his own self-evaluation. I mean, look at his weaknesses in trading: overtrade and undisciplined when mental energy is low. And in his personal life, spread myself too thin. That's the level of honesty that becomes the real starting line for getting better. So once you've figured out where you are, you have to define where you want to go. And that's where a professional mission statement comes in. This isn't some corporate slogan you hang on a wall. It's your personal compass for when things get chaotic, whether you're winning big or just feeling totally lost. Now, here's what's so fascinating about this. Look at what's not on this slide. His mission statement says absolutely nothing about making a specific amount of money. It's all about his process and his attitude. He's focused on the actions that lead to good outcomes, not the outcomes themselves. So the big takeaway here is this: focus on your process, and the results, they'll take care of themselves. Okay, so you have your maybe philosophy, you've got your process-driven mission, but what happens when the pressure is really on and your emotions are going crazy? How do you actually deal with that thrill of a huge win or the gut punch of a massive loss? Well, the answer isn't to just bottle it all up. It's to observe it. See, the goal isn't to get rid of your emotions. It's to understand them. You have to develop what's called metacognition, which is just a fancy way of saying you're thinking about your own thinking. Instead of just being a victim of how you feel, you become a curious observer of it. So here's how that works in the real world. Let's say you just hit a huge win. Step 1, identify the feeling. Don't just feel it, put a name on it. Okay, I am euphoric right now. Step 2, observe the thought that's bubbling up with it. This euphoria is making me want to do something reckless, like double down. And then step 3, course correct your action. Because I know this is happening, I'm going to take the profit and just step away for a bit. It's not about being emotionless. It's about being emotionally smart. And that emotional intelligence is absolutely crucial, especially when it comes to one of the hardest skills anyone can master, the art of failing well. Because let's be honest, in any competitive field, you are going to fail. Probably a lot. And if you think big failures are just for rookies, let me introduce you to Stan Druckenmiller, one of the greatest investors of all time. At the very peak of the dot-com bubble, he knew he shouldn't be buying tech stocks. He knew it. But he got swept up in the emotion, the FOMO, and he bought $6 billion worth right near the top. He lost $3 billion of it in 6 weeks. $3 billion. Even the absolute legends are human. Now, let's contrast that with the mindset of a former baseball player named Lenny Dykstra. Baseball is a game of constant failure. Even a Hall of Famer fails almost 70% of the time. But Billy Beane, the guy from Moneyball, said Dykstra was perfect for the game because he could just instantly forget failure and move on to the next chance. He got it, you know? He understood that every failure was just one data point, not the final verdict. This quote just sums the whole thing up perfectly. Failure isn't the opposite of success. It's the prerequisite. It is the tuition you pay for the experience that eventually gives you good judgment. So the goal isn't to avoid failure, it's to learn from it. And just like Lenny Dykstra, move on, fast. And all of this brings us to the final and I think most important piece of the puzzle. What is it that actually keeps you going through the wins, the losses, the whole brutal learning process? Why do you really show up every day? Early in his career, the author was driven by one thing and one thing only: money. He read Liar's Poker when he was a kid and just knew he wanted to be a Wall Street trader. But a funny thing happens when you actually achieve a huge goal like that. The very thing that pushed you so hard is suddenly gone, and you're kind of left feeling, okay, now what? He realized that if he wanted a long career, money couldn't be the main thing. His motivation had to be deeper. And he rediscovered his love for the game itself, the intellectual challenge, the puzzle of the market that changes every single day. The number one reason you stick with something for decades is because you just love doing it. And man, was that new mindset put to the test. It was the very last day of his worst year ever. After clawing his way back to being just barely profitable for the year, he gets a call at 10 a.m. that completely vaporizes all his hard work, putting him down $600,000. He just walked out of the office, totally miserable, and told his wife, "I don't think I can do this anymore." But he came back. He didn't quit. He stuck to the process. He remembered why he loved the game. And just 12 months later, he was staring at his best year ever, having made over $50 million. And this just perfectly shows the power of a resilient mindset. It's not about avoiding those crushing lows. It's about having a purpose that's strong enough to pull you through them and get you to the next opportunity. So we end right where we started, with the mindset of a pro. It's not just about what you do, but why you do it. Finding that deeper motivation, that love for the process, is what separates a flash in the pan from a truly sustainable, fulfilling career. So, what's your reason?